Okay, here I'm trying again. Seems I have problems putting up some of my pertinent points that actually a lot of it's for me to remember the books that I find this information in. And if anybody wants to join in with me to bring these lies out of the dark and wash them in the sunshine, you're plenty welcome. And this book that I'm stuck on right now is Stealing the Market by Martin Meyer. How the giant brokerage firms, with help from the SEC, stole the stock market from investors. And there's one point in here that I have a lot of questions about. Meanwhile, at the Board of Trade, another form of financial future was being developed by a very different man, Richard Sandor, a curly-haired, whip-smart young University of California economics professor with a specialty in real estate financing, who was interested in improving the secondary market for the federally insured mortgage instruments issued through the Government National Mortgage Association, GNMA, or popularly Ginnie Mae. These were very complicated self-liquidating pass-through certificates, which paid their purchasers from the total cash flow of payments by householders, principal and interest on a large package of mortgages that came due at roughly the same time. When interest rates went up, the pass-throughs paid off more slowly because people were less likely to sell their old homes with their low-paying mortgages and assume a high-paying mortgage on a new home. When interest rates went down, the pass-throughs paid off more quickly because people refinanced their loans. Originators of mortgages had good reason to wish to know the rates at which they could offer mortgages to home buyers in 60 or 90 days, for it took time to close real estate deals. Some investors in mortgages, notably insurance companies and pension funds, received their funds in a rather lumpy fashion, in monthly or quarterly bursts, and had reason to buy instruments that would let them lock in the interest rate that they would receive when they got the money to buy. By the time Sandor's Ginnie Mae futures were ready for trading, Congress had created a Commodity Futures Trading Commission, CFTC, from a rib of the Agricultural Department, and in part at Malamud and Sandor's urging had included in its charter the authority to regulate and supervise trading in futures for tangible and intangible products. So Sandor needed permission and got it. The day before trading was to begin, the SEC sued to enjoin the CFTC from approving the contract on the grounds that it was a security and thus within SEC jurisdiction. But the courts, in a decision that still reverberates, decided that a futures contract was not a security. The case was made easier by the fact that the SEC did not regulate the issuance of the Ginnie Mae's because securities sold by U.S. government agencies are exempt from regulation or even investigation by any other government agency. Ginnie Mae futures never got far off the ground. Mostly, Sandor later realized, because the cash market for Ginnie Mae's was imperfect. Like the wheat contract, the Ginnie Mae future attempted to specify various grades of financial instruments that could be delivered in satisfaction of its terms, but even with the abstract futures contract as a substitute. These certificates were tricky investments for anyone looking to trade the market rather than make long-term investments. Because the cash market was imperfect, the prearranged discounts or premiums for GNMAs of different characteristics, could get out of line with the discounts and premiums that were in fact being charged and received. This would drive the price of the futures contract down as the expiration date neared, because the buyers wanted to sell the contract rather than take delivery, and the sellers of contracts wanted to deliver bargain bonds rather than take any profits they might have, let alone losses they had suffered in the futures markets. One could not mathematically equilibrate a 6% mortgage and a 14% mortgage, because the latter was much more likely to be paid off ahead of time. Finally, there was no way a trader who was long the futures could hedge his position by shorting the actual bonds, because there was no broker or agency lending bonds for the purpose of short sales. Okay, this alerted me to the fact that our government agencies have been open to thieves to do as they please. And they are in cahoots with Wall Street, who I have been studying too. And this book, Liquidated, by Karen Ho, an ethnography of Wall Street, which pretty much means those crooked white men that work for the devil himself to make money. It brings the banks up to the forefront to be big members of our enemies. Despite Clark's problematic conflation of downsizing with economic downturns, he spoke with the understanding and the expectation that downsizings will and should happen. It is through job insecurity, the fungibility of employees, that investment banks make money. That is, I think that it is just a function of the way these companies make money if things are good. If the economy is strong, they are doing a lot of investment banking deals. In other words, because investment banking profits can be highly volatile, the risk of these Wall Street businesses is, to an extent, shouldered by highly paid Wall Street workers who do not complain because they have entered into a contract of high risk and high reward. Almost all my informants not only articulated that no one should be surprised about their insecurity, but also that high risk is precisely how their jobs should be structured. They enter into a risk-reward bargain they fully accept, and it is through this experience that investment bankers learn who is flexible and who can accept change. It is important to note that what is understood to be at risk is mainly their own jobs, not the systemic risk they inflict on the financial markets. I thus begin to realize that as a result of their highly empowered status, network, and compensation, investment bankers' experiences and the effect of their downsizing diverge from that of most workers. Moreover, Wall Street's compensation strategies allow for flexible employment, an approach to compensation that allows investment banks to immediately hire workers and build departments after large-scale layoffs and continual purges, and to produce a strategy of no strategy. They have made our lives and our jobs insecure. And I bet these temporary employment companies are in with it too. And Manpower is one of the oldest, and I work for them. And they were angry that I was honest and sent me to the street. And I'm finding out who our rings of enemies, criminal rings they are. And they need to be put out there in public for the people to know. God bless America, and I hope He helps us wipe out this evil. Y'all have a great day. I'm going to celebrate my birthday. Yeah.